Today, we're going to explore how investors can potentially improve portfolio outcomes by targeting two seemingly contradictory but actually deeply complementary systems, as outlined in the latest Mauboussin and Callahan paper, Probabilities and Payoffs, the Practicality and Psychology of Expected Value. But be advised that understanding this counterintuitive reality is going to require a shift in mindset, one that embraces uncertainty and focuses on the power of diversification. So let's begin. The legendary baseball player Babe Ruth hit 714 home runs, a record that stood for nearly 40 years. But here's another fun fact. He actually retired as the leader in the most strikeouts. Still, nobody remembers his strikeouts. They remember his home runs. The same thing is true in investing. It's not about how often you win, but how much you make when you do win. In fact, you can be mostly wrong most of the time, and you can still come out ahead if your winners make more than your losers. In the paper, the authors show two different types of distributions to show how you can be mostly wrong and still come out ahead. One of them is going to chart human height, and the other city population dispersion. So obviously there isn't going to be one single person in the world that towers 500 miles tall that's gonna throw off the averages for human height. So we can say pretty safely that human height follows a normal distribution. But when it comes to city populations, things are just not so neat. If you think about it, one city like New York could skew averages and make mean and standard deviation poor measuring tools. So when the authors chart these two different types of distributions, one looks pretty neat, while the other really hard to measure what is going on with this distribution. And that's because the outliers are going to have a large effect on averages. Author Nassim Taleb famously uses two quirky terms to describe different types of distributions. The first one is medio-me. So things follow a normal distribution and no single data point can have an outsized impact. And you have extremism or X. This is a world of power law distributions. A small number of events could skew the whole thing: city population, wealth. These types of things are not easily fitted in a normal distribution. But how does this affect portfolio construction? In the paper, Callahan and Mauboussin simplified this idea with a pretty simple and elegant formula, and that's expected value equals probability times payoff. But one thing you'll notice about this formula is that it says absolutely nothing about the frequency and magnitude of wins investors should pursue. So let's talk about these two seemingly contradictory but deeply complementary systems that could help diversify our portfolio. Well, when you look at expected value distributions, investors are able to target two things. The first thing is negative skewness. So these are really high probability, moderately gaining assets. You can think of stocks and corporate bonds. You can usually count on these to make money and steadily make money, but every now and then they just jump off a cliff. The second thing that you could pursue is positive skewness. These are low probability, highly gaining assets. So think long volatility strategies like trend following and tail hedging. By the way, if you don't know what these are, I'll leave some resources down in the description that you can check out. But the idea here is that most of the time, these positions will make you second guess whether you should own them because there's a lot of noise and bleed associated with them. But every now and then, they really shine. But notice how both of these distributions are polar opposites in probability and payoff structures, and therefore they can be really good diversifiers to each other. So let's talk about portfolio construction. And one of the things that could blow up your portfolio is path dependency. To illustrate this concept, the authors present an example from Old Peters of two similar systems that experience wildly different results, even though they kind of seem like similar exercises. Imagine a coin that increases wealth 50% when it comes up heads and decreases it 40% when it comes up tails. So if you start with $1, the expected return is 5 cents. But let's run this experiment twice with a bit of nuance. First, we're gonna have 100 of your friends flip the coin all at once. The likely results of this is that your realized returns won't deviate too much from 5 cents. But let's say you don't have 100 friends to help you out with this experiment, which probably you don't. So you're just constrained to flipping the coin 100 times by yourself. If you were to compound this series over time, it's much more likely you're gonna run out of money well before the end of the experiment, even though the expected return is still 5 cents. So these examples go to show you the dangers of using arithmetic averages versus compounded or geometric returns. But what does this all mean for investors? First, diversify your bets. Of course, most investors know not to invest all their wealth in one single stock, and they make a point to diversify within asset classes, namely stocks. But they seldom ever do the same thing across asset classes. So here is a tip for you. If you combine negatively skewed assets, such as stocks and bonds, and positively skewed strategies such as trend following and tail hedging, you may be able to minimize the randomness introduced by path dependency. The second tip is to target winners. And while the first tip was mostly important for retirees, this one could really help retirees and people accumulating wealth. And that is to target momentum exposures within and across asset classes. In short, momentum has not only enhanced returns, but has also at times improved drawdown profiles. The third tip is to cut your losses short. I know that trend following has not been the hottest thing in the market, but I think the math remains too powerful to ignore. Much like the power loss behind the Babe Ruth effect, trend following strategies reinforce the principle that investing isn't about being right most of the time. It's about making the most when you are right. Here is the thing. Investing is a game of survival, and even the best ideas could be catastrophic to investors if they can't stick with them or if they happen to catch the wrong return path. Therefore, investors must implement portfolios that increase the chance for success. And that success means both economically and behaviorally. See, the goal isn't just to win. It's to stay in the game long enough for the odds to work in your favor. Here at Alpha Architect, our goal is to empower investors through education. We're an asset management firm that focuses on delivering affordable alpha to our clients. If you want more educational content like this, head to alphaarchitect.com. I'll see you there.